April 10th, 2024, Brussels, Belgium. The finance ministers of the G7 nations gather for a closed-door meeting. On the agenda, what do we do with Russia's frozen reserves? Since February 2022, the West has held $300 billion in Russian central bank assets. Frozen, not seized, frozen in place. The money sits in accounts at Euroclear in Belgium, at the New York Fed, at the Bank of England. Russia can't access it, but the West hasn't taken it either. For 2 years, this frozen wealth has been leverage. Give up Ukraine, get your money back. But by April 2024, the war is in its third year. Ukraine is running out of money. Congress is gridlocked on more aid. Something has to give. In that conference room, a decision is made. The G7 will seize the interest. The $300 billion generates approximately $3 billion per year in interest. That interest will be transferred to Ukraine. The announcement comes April 30th, 2024. Headlines celebrate it as justice. Russia's frozen assets will rebuild Ukraine. It's elegant, it's creative, it's punishment without full confiscation. But in central bank headquarters across the world, in Beijing, Riyadh, New Delhi, Abu Dhabi, Brasilia, a very different conversation is happening. The ministers are asking their staff the same question. If they can do this to Russia, can they do it to us? The answer, obviously, is yes. If the West can freeze $300 billion for political reasons, and then use those assets to fund a war against the owner, then any country's reserves held in dollars, euros, or pounds are vulnerable. Your sovereign wealth is only sovereign until it isn't. And so, quietly, without announcements, without press releases, central banks around the world began doing something they hadn't done at this scale in 50 years. They began selling U.S. Treasury bonds. Not all at once, not in panic, but steadily, systematically, month after month. By December 2024, 8 months after the G7 decision, foreign holdings of U.S. Treasuries have fallen by $400 billion. China has sold $89 billion. Japan has sold $95 billion. Saudi Arabia has sold $32 billion. This is not normal profit-taking. This is a coordinated, global, strategic move away from U.S. Treasury bonds, triggered directly by the decision to seize Russian interest. And it has only just begun. Here's the complete history of how we got here. The specific mechanism by which seizing Russia's $300 billion triggered a global flight from treasuries. The data showing this is happening right now. Which countries are selling and what they're buying instead, who's absorbing the selling, and what happens when the answer becomes the Federal Reserve, which is the technical definition of a failed treasury market. Because this isn't about Russia. Russia lost $300 billion, but the real damage is to the United States. By weaponizing the treasury market, the U.S. destroyed the thing that made American power possible. The ability to borrow unlimited amounts at low interest rates because the world trusted U.S. debt above all else. That trust is gone. And once trust is gone, it doesn't come back. Before February 2022, the U.S. Treasury market was the deepest, most liquid, most trusted financial market in the world. Total U.S. government debt held by the public, $24 trillion. Foreign countries held about $7.6 trillion, roughly 30%. China held $1.1 trillion. Japan held $1.3 trillion. This was normal. This had been stable for decades. Foreign countries accumulated dollars through trade surpluses and needed somewhere safe to store them. U.S. Treasuries were the obvious choice. Safe, liquid, backed by the full faith and credit of the United States. More than that, Treasuries were considered above politics. Yes, the U.S. had frozen assets of enemy nations before. Cuba, Iran after 1979, North Korea, Libya, Venezuela. But these were small countries, rogue states, acknowledged enemies. The rules were clear. If you're a normal country with normal relations, your treasury holdings are safe. This implicit guarantee was the foundation of dollar dominance. The U.S. could run unlimited budget deficits because the world would always buy the debt. This was the exorbitant privilege. On February 24th, 2022, Russia invaded Ukraine. Within 72 hours, the West announced that Russian central bank reserves would be frozen. Total, $300 billion and $100 billion in Euroclear. $100 billion at the New York Fed, $50 billion at the Bank of England, $50 billion in other European central banks. This was unprecedented, not because of asset freezes generally, but because Russia wasn't North Korea. Russia was the 11th largest economy. Russia was a major energy exporter. Russia was a permanent UN Security Council member. And Russia held $600 billion in total reserves, of which $300 billion was in Western currencies, specifically as insurance against sanctions. Russia had diversified into Western reserves thinking they were safe. They were wrong. Every other central bank took notice. The immediate reaction was muted publicly, but intense privately. Central bank governors called emergency meetings. The question everyone asked was simple. How much of our reserves are vulnerable? For China, the answer was terrifying. China held $3.4 trillion in foreign exchange reserves. roughly $1.1 trillion in U.S. Treasuries, another $500 billion in other dollar assets, over $1.5 trillion potentially vulnerable if relations with the U.S. deteriorated. For Saudi Arabia, $120 billion in treasuries. For the UAE, $40 billion. For Taiwan, $240 billion. For South Korea, $170 billion. Every country with substantial dollar reserves realized those reserves were hostage to U.S. foreign policy. If the U.S. could freeze Russia's $300 billion for invading Ukraine, the U.S. could freeze anyone's reserves for any reason Washington deemed sufficient. The reserves weren't safe. They were leverage. But the freeze alone wasn't enough to trigger mass selling. Central banks moved slowly. They hoped the freeze was temporary, tied specifically to the Ukraine war, that once the war ended, normal rules would resume. That hope died April 30th, 2024. The G7 announcement that Russian frozen assets would be used, that the interest would be transferred to Ukraine, crossed a line. This wasn't freezing pending resolution. This was confiscating assets and giving them to Russia's enemy. The legal justification was creative. The interest isn't the principal. Russia still technically owns the $300 billion. The West is just taking the profits. But from a central bank perspective, the distinction was meaningless. If you own an asset and someone takes the income it generates, you don't functionally own it. This was the signal that Treasury holdings could be confiscated for political reasons. And the selling accelerated. The data is public, released monthly by the U.S. Treasury. Here's what happened after April 2024. April through December 2024. Foreign holdings fell by $400 billion in 8 months. China sold $89 billion. Japan sold $95 billion. Saudi Arabia sold $32 billion. Belgium, which holds Middle Eastern money, sold $25 billion. The Cayman Islands, proxy for Chinese institutional money, sold $18 billion. This is the largest sustained foreign selling in U.S. history outside of a financial crisis. And this is just the beginning, because central banks don't move all at once. They sell gradually to avoid crashing the market and the value of their remaining holdings. The selling we've seen is the cautious first wave. The real wave is coming. When foreign central banks were the marginal buyers of treasuries, the U.S. could borrow unlimited amounts at low rates. Treasury issued bonds. Foreign central banks bought them. This kept yields low, even as debt grew. But when foreign central banks stop buying and start selling, someone else has to buy. There are 4 possible buyers: domestic institutions, domestic households, foreign private investors, and the Federal Reserve. Domestic institutions like pension funds already hold $6 trillion in treasuries. They can't dramatically increase without dangerous overexposure. Domestic households hold $3 trillion and aren't increasing. Foreign private investors face the same freezing concerns as central banks. That leaves the Federal Reserve. The Fed is supposed to be independent of the Treasury. But when nobody else will buy, the Fed has to step in or yields spike and fiscal crisis ensues. This is called debt monetization. The central bank printing money to buy government bonds. It's what Zimbabwe did, what Weimar Germany did, what Venezuela did. It always ends in inflation or currency collapse, and it's already happening. In early 2024, the Fed held $5 trillion in treasuries. By December 2024, $5.2 trillion. The Fed is buying again despite claiming it's reducing its balance sheet. Why? Because somebody has to buy. Foreign central banks are selling $400 billion. Domestic buyers aren't increasing. The Fed absorbs the selling. The Fed's share of the total treasury market increased from 20% in early 2024 to 22% by year end. That's a 10% increase in Fed ownership in 8 months. This is the debt monetization death spiral beginning. Let me show you the specific countries selling and why. China reduced treasury holdings from $1.1 trillion in March 2024 to $980 billion by December. That's $120 billion sold in 8 months. China is selling for 2 reasons. First, China saw what happened to Russia and knows it could be next if it moves on Taiwan. Second, China is preparing for a post-dollar world, building CEP's payment system, negotiating oil purchases in yuan, lending to Belt and Road countries in yuan. Japan reduced holdings from $1.2 trillion to $1.1 trillion, a $100 billion decline. Japan is a U.S. ally and isn't afraid of freezing, but Japan has its own fiscal crisis. Japan needs to finance its own 260% debt to GDP, so Japan is selling treasuries to fund its own borrowing. This is significant because Japan has been the most reliable treasury buyer for 30 years. Saudi Arabia reduced holdings from $135 billion in 2023 to $90 billion by end of 2024. That's a 33% reduction in 18 months. Saudi Arabia is a U.S. ally, but saw Russia's reserves frozen and asked, could the U.S. freeze ours? The answer is yes. If Saudi cut oil production against U.S. wishes, if Saudi aligned too closely with China, the U.S. could freeze reserves. Saudi is diversifying, buying gold, accepting yuan for oil, joined BRICS in January 2024. The UAE, Kuwait, and other Gulf states are following Saudi's lead. Combined, Gulf countries reduced Treasury holdings by $80 billion in 2024. The selling is global. It's coordinated not through conspiracy, but through shared fear. Every central bank saw what happened to Russia and decided reduce Treasury exposure. What are they buying instead? Gold. Central bank gold purchases in 2024 exceeded 100 tons for the third consecutive year. Highest sustained buying since the 1970s, right before the gold standard collapsed. China officially bought 225 tons in 2024, likely 400 plus tons unofficially. Turkey 80 tons. India 75 tons. Poland 60 tons. Why gold? Because gold can't be frozen. Gold held in your own vaults is yours. Russia's gold in Russia was never frozen. Only Western reserves were. Every central bank learned, hold gold domestically. Other currencies. The yuan's share of global reserves increased from 2.3% in 2022 to 3.2% by 2024. That's 40% growth in 2 years. Still small compared to the dollar's 58%, but the trajectory is clear. Commodities. Some central banks are buying strategic commodities: oil, copper, rare earths, assets with intrinsic value that can't be digitally frozen. The pattern is clear: diversification away from treasuries. And the more they diversify, the fewer buyers there are for new issuance. Here's the mathematical problem this creates. The U.S. government runs deficits of $2 trillion per year. Total borrowing needs, $7 trillion annually. $2 trillion net new plus $5 trillion refinancing maturing debt. Before 2022, foreign buyers purchased 30% of new issuance, roughly $600 billion annually. Domestic buyers purchased 50%, about $1 trillion. The Federal Reserve purchased 20%, about $400 billion. Now, post-April 2024, foreign buyers are selling $400 billion per year instead of buying $600 billion. That's a $1 trillion swing. Domestic buyers haven't increased, so the Fed has to cover. The Fed's purchases increased from $400 billion to $1.4 trillion annually to absorb both new issuance and foreign selling. This means the Fed is now buying roughly 70% of net new Treasury issuance when accounting for foreign selling. The Fed is the market, and when the central bank is the market has failed. This creates a death spiral. The Fed buying Treasuries means printing money. Printing money causes inflation. Inflation reduces the real value of Treasuries, making foreign holders want to sell more, which forces the Fed to buy more, which prints more money, which causes more inflation, which triggers more selling. This is how a currency loses reserve status. Let me show you the timeline. 2022, February. Russia's $300 billion frozen. First seed of doubt planted. 2022-2023. Cautious diversification begins. China, Saudi Arabia start slowly reducing Treasury holdings. 2024, April. G7 announces use of Russian assets. Doubt becomes certainty. Selling accelerates. 2024-2025. Foreign selling intensifies. $800 billion to $1 trillion annual outflow expected. Fed buying increases to compensate. 2026-2028. Breaking point approaches. Foreign holdings fall below $6 trillion. Fed holdings exceed $7 trillion, 30% of all treasuries. Markets begin pricing inflation risk. 10-year yields rise from 4% to 6 to 7% despite Fed buying. 2029-2032. Crisis becomes visible. Treasury auctions start failing. Yields spike to 8 to 10%. U.S. interest payments on $40 trillion debt exceed $3 trillion annually, consuming 60% of tax revenue. Fed forced to dramatically increase buying. 2033-2037 currency crisis. Dollar loses reserve status for commodities. Dollar's share of global reserves falls to 40%. Inflation accelerates to 7 to 10% annually. 2037 to 2042, dollar no longer dominant reserve currency. Still largest single currency, but not hegemonic. U.S. must balance budget or face hyperinflation. This timeline assumes gradual decline. It could accelerate with a trigger event. Taiwan invasion, major bank failure, political crisis. But even without shocks, the mathematical endpoint is the same. When the central bank is the primary buyer of government debt, the currency is doomed. Who wins and who loses? China wins strategically. China is selling treasuries, buying gold and commodities, building CIPS alternative payment system. When the dollar loses reserve status, the yuan rises by default. China is preparing for a post-dollar world while the U.S. clings to dollar dominance. Gold holders win. As central banks buy gold to replace treasuries, prices rise. Gold currently around $4,300 per ounce. If central banks continue buying 1,000 tons annually for a decade, gold reaches 7,000, 8,000 by 2035. a 200% return. The United States loses hegemony. The ability to borrow unlimited amounts at low rates funds the military. Social Security, Medicare, allows Americans to consume more than they produce. When the Treasury market fails and borrowing becomes expensive, all of this becomes unaffordable. The $880 billion military budget is sustainable at 3% borrowing costs, unsustainable at 8%. American consumers lose purchasing power. Americans import $3.8 trillion and export $3 trillion, an $800 billion deficit. This works when the world accepts dollars. When the dollar loses value, imports become expensive. Gas, electronics, clothing all rise 30 to 50% over a decade. U.S. Treasury bondholders lose wealth. If yields rise from 4% to 8%, existing bonds lose 30-40% of value. Domestic institutions hold $9 trillion in treasuries. That's $3 trillion in potential losses. Retirees lose security. As the dollar loses purchasing power, Social Security and Medicare benefits decline in real terms. A $2,000 monthly check today might buy $1,100 worth of goods in 2035. This is the distributed cost of reserve currency collapse. Not one dramatic crash, but slow erosion over 10-15 years. Why is this irreversible? The Treasury market is based on trust. For 80 years, the world trusted that U.S. Treasuries were safe regardless of politics. The trust allowed the U.S. to borrow at privileged rates. But trust, once broken, is nearly impossible to restore. Russia's reserves were frozen. The interest was confiscated. Every central bank saw this. They can't unsee it. Central banks know that U.S. law allows the president to freeze foreign assets under the International Emergency Economic Powers Act. The president just has to declare an emergency. Ukraine was an emergency. Taiwan would be an emergency. Anything can be an emergency. So no central bank can trust their reserves are safe. Without trust, they must diversify. The U.S. could restore trust by stripping the president of asset freezing authority. But that won't happen. Asset freezing is too useful. The U.S. could hold assets through a neutral third party like the Bank for International Settlements. But that means surrendering control. There is no way to restore trust without surrendering the weapon. And the U.S. won't surrender the weapon. But the weapon is killing the thing that gave the U.S. power, the Treasury market. The historical parallel? In 1914, Britain weaponized finance by seizing German assets during World War I. Neutral countries saw that Britain would seize assets for political reasons. They diversified away from pounds. After WWI, New York began replacing London. By 1944, at Bretton Woods, the dollar formally replaced the pound as reserve currency. Britain's financial dominance lasted 30 years after the 1914 weaponization. The U.S. froze Russia's reserves in 2022. If the pattern holds, the dollar loses reserve status by 2052. But modern technology accelerates everything. Central banks can shift reserves in hours instead of months. China's CIPS went from $12 trillion in 2020 to $27 trillion in 2023, doubling in 3 years. My estimate? The dollar loses reserve dominance by 2037-2042, about 15-20 years from the 2022 freeze. Dollar's share of reserves falls from 58% today to 35-40% by 2040. Still the largest single currency, but not hegemonic. And the catalyst was seizing Russia's $300 billion, specifically the April 2024 decision to use the assets. That was the moment trust shattered irreparably. The United States had a choice in February 2022. Freeze Russia's reserves as leverage, or accept that financial warfare has limits. The U.S. chose to freeze. That was defensible. But in April 2024, the U.S. made a different choice. Use the frozen assets. Take the interest. Transfer it to Ukraine. That crossed from freezing to confiscation. And that destroyed the Treasury market. Because once you confiscate reserves, every country knows their reserves aren't safe. They can't trust you. And once trust is gone, the privileged position is gone. The Treasury market is dying. Foreign central banks are selling $800 billion to $1 trillion per year. The Federal Reserve is buying to compensate. The Fed's share is approaching 30%. When the central bank owns 30% of government debt, you're approaching the definition of a failed state. The timeline is 15 to 20 years. By 2037-2042, the dollar is no longer the dominant reserve currency. The Treasury market is no longer the safe haven. The U.S. can't borrow unlimited amounts. The free lunch is over, and the trigger was seizing Russia's $300 billion. The U.S. gained $300 billion in frozen assets. The U.S. lost the trust that supported $7.8 trillion in foreign treasury holdings. That's a 26-to-1 loss ratio. Russia lost $300 billion. America lost its financial empire. And the beneficiary is China, which watched, learned, and prepared while America destroyed its own advantages. If this showed you that the Treasury market is dying because of the April 2024 decision, if you understand that foreign central banks are selling treasuries right now and the Federal Reserve is becoming the buyer of last resort, If you see this as the beginning of dollar reserve status collapse over 15, 20 years, subscribe, because the next video shows what happens when Treasury yields spike to 8 and 10% and the U.S. can't afford to service $40 trillion in debt. The three options: default on Social Security and Medicare, hyperinflate the debt away, or restructure into regional currencies. All three destroy the American middle class. The $300 billion they took from Russia will cost America $30 trillion in lost Treasury demand over 20 years. That's a 100-to-1 loss. They broke the safe asset, they killed the Treasury market, and they did it to themselves.